All right, well, good morning. Welcome to a special breakfast edition of the Jack and Bill Show.
I'm Jack Ditt,
And I'm Bill McCollum.
and this is the Jack and Bill Show.
We are minus our production crew today, so we're having to do this solo, the two of us. I'm happy to welcome Jack back into the saddle. We missed him last week. There's been a lot of things going on since we visited last Friday. And as you may recall, for those who tuned in, I talked about the impact of the Federal Reserve cutting the Fed funds rate by 25 basis points, and also talked about the impact of tariffs, additional tariffs on Chinese imports. Well, there's more to the story, and we did see retaliatory action by the Chinese government. They announced that they would cease imports of U.S. agricultural products, and that really shook the markets on Monday. And we've seen a lot of back and forth since. Jack, would you care to comment on that?
Yeah, that's right. You've kind of touched on a little bit. We did want to talk or discuss, why so much volatility in the last 2 weeks. And I guess it began with the Fed tightening. The markets really wanted a whole lot more. And then, as you said, the China trade deal. And actually, this morning, the stock market has just gradually been drifting a little bit lower. We're down about 2/3 to 3/4%. We have oil up about $2 this morning, West Texas Intermediate, which is a little bit unusual because oil and nat gas prices have just fallen through the bottom with the perception that the global economy may be slowing. So, but this is what we wanted to talk about a little bit, about this volatility. Volatility is an opportunity. And since December, the beginning of last December, we've had 3 market declines greater than 5%. And this is one of those. So, we had a large market decline in the fourth quarter last year. In May of this year, we had a decline of 6.4%, but we recovered all of that back in June. So then here we are again. We've declined 6.7% on this news, and fear and panic. There are 2 emotions, I think you want to talk a little bit about this, Bill, that really drive the markets in the short term, and that is fear and greed. So since we were down about 6.7% over the last 2 weeks, down 3% on Monday, which is the worst day of the year for the U.S. stock market, the global markets were all down as well. And then we rebounded sharply the last few days, about 4%. And now we're down about 3.5%, from the all-time highs, with the U.S. stock market still up about 18.5% on a total return basis on the year. I did want to mention one other thing, Bill, but we've gotten into rarefied air in one aspect. When you look at
Rarefied air?
Rarefied air, that's correct. Up until about 1958, stock yields, the dividend return or dividend yield on common stocks exceeded that of the bond market. But we've been in a secular decline with Treasury note yields or mortgage yields, for example. Everything trades off of the U.S. Treasury from, I think the peak was in March of 1980 all the way to now. So this is a long-term secular, not seasonal or cyclical, decline in interest rates. And here we are with this fear and panic. The 10-year Treasury note yield is now only about 1.7%, yet the S&P 500 is yielding 1.85%. So we view that as spelling opportunity. What do you make of that, Bill?
I totally agree. I must say, though, I'm still thinking about rarefied air. I'll resist the temptation.
How long will it last is the big question. And what do we do to take advantage of it is the next question.
This is the one thing that we want to discourage you from doing, and that is getting whipsawed by the news flow. And even more specifically, Twitter feeds from the president. Okay? This is not a time to be trying to react to the news flow. Sometimes the best thing to do is just take a breath and don't even look at your investment portfolio. It's very easy to get sucked into that and try to outsmart the markets based on what you're reading. But here's the thing, the markets are fairly efficient, not perfectly efficient, but fairly efficient insofar as market prices reflect all available historic and current information. And so when you see a market decline like on Monday of 3%, that can be distressful, if you are following it closely. And it can be very easy to make a knee-jerk reaction and sell out of the market or even reduce your equity exposure based on what happened that day.
But Bill, just as you're saying, that 3% decline is discounting all future expectations. So that means the next day it would take different news to make the markets move
correct.
Again, right?
That's correct.
Yeah, and weren't you going to talk a little bit about market psychology? Because I was going to throw in there that, we give the greatest weighting in our minds to those things that we see, read, and hear. Most recently, we can also tend to believe the TV or the printed word, but we give this weighting in our minds to that which we read, see, and hear most recently, and then we extrapolate it forward. And if you do that with stock and bond investments, your portfolio is going to get out of balance from your original asset allocation. And that's why we like to use these kinds of volatile markets to rebalance the desired level of stocks and bonds that comes from the client, or it comes from you, how much you should have in stocks and bonds. And when they gyrate around, you rebalance them. You sell that which is high and you buy that which is low. And we've had 3 opportunities since December, to do this.
Correct.
But back to the market
Well,
psychology.
let me put on my psychologist hat. What Jack was referring to about putting the most weight to the most recent news, that's called recency bias. That's the term that psychologists use. And it's very easy to look at, say, Monday's sell-off and make a conclusion based on that, the most recent activity in the market, that we are on a downward path. And in fact, it was the opposite. So for those who got nervous and took action and sold out on Monday, they missed one of the biggest rallies of the year this week. So recency bias can really get you in trouble. The other is overconfidence. That's another psychological flaw that investors have to overcome. We can be overconfident in our own abilities. So we want to be mindful of the mistakes, the mental errors, not just that everyday investors make, but professionals too. We can make these mistakes too if we're not careful. But we would tell you that one of the best things that you can do is just turn off the news. If you are following like CNBC every day, you are being inundated by noise. And it's interesting how they will have Bubble vision, exactly. And they will bring guests on who will have a view that lines up with the action of the day. So Monday, they had all the bearish investors on. And then later in the week, they brought all the bullish investors on, when the markets were up. So it's just going to get you into a state of confusion. Do yourself a favor, turn off the news.
Yes, and to add to that, one of the things I've noticed, Bill, with people who call in is stock market investing is meant to be long term. Mm-hmm. It's like would you buy a house and see real estate prices decline 5% and want to sell your house in 3 months? So it's like our friend Warren Buffett, one of the greatest investors of all time. He says that if you have a punch card with 20 holes in it, that would be the best way to make investment decisions. He wishes that he could punch that card and hold a stock for a lifetime or generations. And so, but what we've discovered is that for our clients that look at are constantly looking at things, looking at the news, looking at the stock market news every day, listening to Bubble Vision or CNBC or Fox News, is they tend to that tends to be correlated to activity. In other words, wanting to trade more, versus someone who looks at their statement thoroughly once a month and doesn't panic or get into fear. They're typically going to trade less, and too much trading can really cause some problems.
Absolutely. And you have to be willing to own a stock for the long term. Don't go into it with the attitude of, I'm going to rent this stock investment, meaning or implying that you're just going to trade in and out opportunistically. That's really not a good investment strategy for you. A better approach is to buy something and own it because of the fundamentals. Don't go into it trying to trade.
Well, Bill, I wanted to transition into something that we've heard a lot, and that has to do with some of the things we discussed on some of the recent calls. Is this the end of the bear market? Is a recession coming? Is the bull is this bull market over? But there's a portfolio manager who's a friend of ours named Bill Miller, who's talked about the history of the bull markets, and the bull doesn't end until, historically speaking, 2 out of 3 things happen. And that is, 1, a tightening Federal Reserve, 2, an energy shock in oil or gas prices at the pump, and 3, a recession. So if you look at all 3 of those right now, we've got, West Texas Intermediate, we commented, it was 52 this morning, it's up to 54 today, but that translates into what? $2.25 in gasoline prices. That's very low by historical standards for the American consumer. So that's a plus. We're not in recession. We reported on the GDP growth number at 2.1%. Certainly this trade war could make things slow down a little bit. So the numbers in the next 2 or 3 months are going to be telling. And then the Fed tightening stance. This is the most important one to me, is to watch the Fed, but the Fed announced with the 25 basis point cut. Now you would say, okay, they're no longer in a tightening stance, they're in an easing stance to stimulate. Tightening has more effect, we think, than easing, but to get back to our point on the 2 out of the 3, Fed tightening, energy shock, and recession, the Fed technically is still tightening till the end of this month because they're unwinding the Fed balance sheet, where the Federal Reserve bought $4.5 trillion worth of treasuries and mortgage-backed securities during the subprime crisis, and they've unwound about $600 billion of that. Now's the time the FOMC is determined to stop that this month. So we will officially be in an easing stance. That means instead of having 2 out of 3, we've got 3 out of 3 which are positive to keep the party going in this, this bull market. As we talked about, bond yields are very low. Stock yields are higher than the bond yields. We believe this is an opportunity to stay put in the stock market. And what else would you add to that, Bill?
Well, I would just add that what we're saying is not scientific. Of course, anything could come out of the blue and derail the bull market in stocks. But if we just use those 3 things as a roadmap or a guide to help us, then we say we're still constructive on the stock market going forward.
That's good.
We will continue to watch it. Everyone should be very sensitive to things going on in the world, like what's going on with bond yields and global central banks being so accommodative, because elsewhere outside of the U.S. we are seeing economic weakness. But that's why you hire someone to help you, frankly, is to navigate through all this confusion. That's what we do.
And I would add, in conclusion, I think we're wrapping this thing up. William, I've got to jump on a plane and go to a birthday party in the Commonwealth of Virginia here in a few minutes. But I would just say, with all this volatility, this is a wonderful opportunity. Given the stock market is up 18% this year, the bond market is up nicely as well. Have an overview, have your portfolio reviewed with a professional, and make sure that the balance, your asset allocation, the slices of your pie of stocks and bonds and alternatives, other things, are perfectly aligned with your return expectations and your risk tolerance. This is a time to take a healthy, serious look at all that and make sure you're positioned appropriately.
Great advice. Great advice. Okay, well, we are done. Thank you for joining us. Have a great weekend. And we will see you next Friday back at our normal time, 3:30. Bye-bye.